Hello, hello. Today I'm going to record myself going through an annual report. By having you alongside me, I'm hoping this will make you more confident in talking about businesses, really asking questions, not being afraid to look at a number or two. Please make sure to like and subscribe while I focus on making your wisdom blossom. Here we have Orbital Infrastructure Group, a Texas company. Those are becoming more and more popular lately. Without knowing much about the company itself, we can already get an idea from the name of what sort of company it is. The word infrastructure here really is common in very specific types of industries. Without having any reason to doubt yet, let's just assume this is an infrastructure company. Orbital, something to do with space. I mean, we get excited here. Is this a space company? Are these the ones that are going to take us to Mars? So as our opening move, we're going to go to the item 8. They've included a helpful sub table of contents. Love to see that. The audit is actually slowing me down here. I scroll. It's still going on. Wait a minute. Going back to the top, there is substantial doubt about the company's ability to continue as a going concern. Yikes. If the auditors have caught up, then we're really in trouble. Now, that's a joke, by the way. Respect your auditors. The basis for the opinion, let's just stick to looking at headers here. Revenue recognition, estimated costs to determine progress towards contract completion, and then it continues, but essentially the contracts may not be completed, and so revenue may not be what is being said on the financial statements. Interim impairment assessments, ooh, those are nasty. That means the company owns things that yesterday, last year, whenever they said this is worth X, no one doubted it. The auditors themselves did not doubt it. Now the company's saying, oops, actually, X was probably a bit too high. Now these numbers here, 13.4 million, 7.7, 4.6, this is multiple things. This are small numbers. That's a bad combination. Usually, if you see small numbers, you don't want to see a lot of complexity. Small businesses don't need to be too complicated. This business, millions of dollars is still millions of dollars, but if these are significant numbers for the business and there's so many of them, that could be a bad combination. Interestingly enough, the balance sheet is actually presented before the income statement. Yikes. I haven't seen a single number yet, but everything about this is speaking maybe we shouldn't be a business. Remember, this is a snapshot, and so we're going to zoom out from the day to day, really try to get a feel for trends in where the business is putting its resources and how those resources are transforming over time. They have what looks to be a good amount of cash until you realize how much they owe. In particular, the amount of accounts payable has quadrupled in a year, while their cash has dipped a little bit. Yikes. Notes payable is actually so huge. It's not their only source of debt. It's specifically traditional debt. They also have a line of credit. They also have ongoing lease obligations, ongoing financing lease obligations. So even they weren't paying for completely. They were taking on additional debt in order to pay the operating lease beyond what they were paying themselves. They've accrued expenses. That's probably similar to accounts payable. I don't know. Contract liabilities. I mean, that's just more expenses, really. Financial instrument liability. Ooh, it's large. I don't know what that is, but it is large. Liabilities held for sale. Wow, they've already been trying to do things that you see a bankrupt company doing, which is sell its debt to people who specialize in distressed debt. And that's all just for the current year. In general, they have 100,000. That's 5 times more notes payable in the future than they have in cash. The auditor's saying there shouldn't be a going concern potentially. That's a lot of debt for someone who's not even sure they can make money at all. Okay, let's look at how the stockholders' equity is breaking down. They they don't even have something for retained earnings. They've just renamed retained earnings accumulated deficit, and it is large. So normally when looking at a balance sheet, I really try to keep my emotions to a minimum. With that being said, the word I would use to describe this balance sheet is growth. Let's try to use the other statements to figure out what has been going on here. Oh no. Oh no. Oh no. This is a really I hope everyone that's working here the best, honestly, no matter what happens. This is so sad, really. What happened was they're selling something that has demand. I mean, their revenue is almost quadrupled in just a year. But this impairment of goodwill and intangible assets, this is just some purchase they made at the very beginning was a very bad purchase. And we can find out what that purchase was for sure. With the word orbital, they clearly have something related to space that they're working on. Even though they're trying to do business amongst the stars, their profit is not lifting off. Hey everyone, if you're getting more comfortable with the stories behind the numbers, please like and subscribe. Looking at the cash flow statement, they've been trying to work with creditors. Here you can see an amortization of debt discount, but the creditors might not have that much patience anymore, which is why the tone of this specific 10K is so pessimistic. Um, they've been holding out money for bad debt, they've been deferring income taxes, they've been adjusting all of their liabilities. None of it is seeming like enough, unfortunately. All that it's happening is keeping them a little bit less in a hole. That's just, you really got to wonder if the people involved in this company aren't just thinking maybe let's just get a job somewhere else. Now, of course, this company could secure more financing. Let's scroll down to what they've been doing on the financing side. It's a bit of a tricky balancing act. I see now why the auditor was so convinced that they needed to write a forward about whether this is a going concern or not, is that this company has been receiving financing over the last couple of years. Remember, the rightmost column is the furthest back in history. But this is the first year where they really just have to start paying that debt that they've been accumulating. That makes it so that all the debt that they take on from this point on is very much going to go towards paying off the debt that they had in the last couple of years. I mean, arguably, they've kind of run out of time unless someone is willing to lend them a new level of expenses to give them breathing room again. A very, very sticky situation to be in. We're going to do the rare thing of looking at another financial statement that normally I ignore. This is the stockholders' equity. This breaks down where all the money they've received from investors is accounted for. Basically, there is none. Just really wanted to confirm it. Last year, 2021, in this case, was the first time that all the debt that they were able to receive ended up just dissipating from their perspective. They couldn't even get it into drumming up new business. They were too busy paying back things that they owed to different creditors, to different, well, really mainly just to creditors, and then not really making the investors complete. Numbers that are relevant here are that they went from having 96,000, so 96 million roughly in stockholders' equity in the end of 2021. That has dipped to significantly negative. Are they going to be able to raise more money when no one is receiving really what they want completely? A question of what is it that they're doing? So let's maybe look at that. We're going to have to go to the very top again and look at a brand new part of the table of contents. Now, I talk about item 8 as the numbers, and everything else, in particular part 1, is just words. We're going to dive into the words. Item 1, business. The company is a diversified infrastructure services company serving customers in the electric power, telecommunications, and renewable markets. In the fourth quarter of 2021, the company's operations were reclassified into 3 reportable segments: electric power, telecommunications, renewables. Okay, now let's look into the segments. Electric power segment, They do engineering, design, installation, upgrade, repair, and maintenance of electric power transmission and distribution infrastructure and emergency restoration services. So these are the people hanging from the light poles that you see near the street. Are those what they're called? Light poles? The cables, the electricity cable poles. Telecommunications segment provides enterprise solutions to the cable and telecommunication industries and was acquired in 2021. Ooh. Renewables, engineering, procurement, and construction services that support the development of renewable energy generation focused on utility scale solar construction. So they build solar panels. Oh, that's interesting. That's where the Orbital comes from then. I guess they never wanted to take us to Mars. Although there will be need for solar panels on Mars. We're going to go to item 2, properties. I specifically want to see if they're going to mention anything about their intangibles. So actually, this is literally just listing offices. Now, I didn't expect to find this, but each paragraph here is essentially contains an office space, except for this one. Some of them contain multiple office spaces in the paragraph, and so let's just assume it balances out and say that roughly they have 8, 9 offices. In the future, we may obtain additional lease properties. That's a lot of offices. That's a lot of offices, guys. I think you guys have less than 2,000 employees. Why so many offices? We are back in the item 8. I'm going to be looking for some of the notes. I'm really trying to find what is the impairment of goodwill that was massive and that really is from the income side what is making this a very questionable ongoing concern. Okay, I think we found it. Identifiable finite-lived intangible assets. Now, that is their fancy way of saying, have we been buying other companies and or licenses, etc., in intelligent ways? Every time they buy something, they have to justify that in the accounts, in the financial statements, by listing certain assumptions, which then translate into different accounts that we will see in the statements. Here, I am interested in seeing this 15, customer relationships for frontline power construction. They were thinking that the customer relationships would have an estimated useful life of 15 years. Now, they've been doing lots of acquisitions. They've been acquiring leases all over the place for some reason. So it's not one thing that leads to this. Their culture can be exemplified by this acquisition of Frontline Power Corporation based off the assumption that they'll be able to profit off the customer relationships for 15 years. Really seems to have happened with the impairment is these assumptions were not correct. 15 years for Frontline Power Construction. We can go back to the very beginning, but what they were saying Frontline Power Construction does is anything that you tell us. Everything from emergency repair to will maintenance to will build you to it's electricity in the broadest sense. They acquired this company and then told the customers unclear definition of why they should continue to stay with the new company. So the customers left, which normally is fine if you expect that. But when they expected and when they were managing their finances as if they would have those strong customer relationships for 15 years, the two things did not meld well together. Arguably, several of these other intangible assets might have similar things. And overall, collectively, it is the combination of them acquiring businesses into this kind of hodgepodge of we'll figure out what we do maybe without any real direction. It caught up to them. To further confirm this, we now have an investments and fair value measurements note. This is breaking down where the changes in fair value are coming from. While Frontline specifically is going through a transition period, we can see that some of the previous individual owners of Frontline are doing much better than the overall company, but maybe let's not focus too much on that. Be careful when you purchase a company. be careful if the contract is really, really long. I mean, obviously, I didn't see the contract that they're talking about here, but with this many levels of having to pay for something, like if you're not careful with what you sign, you might end up having to pay for a company over and over and over again. Another item here that's of relevance, given the fact that this company might not stay a going concern for the foreseeable future, is let's look at what they actually own. When a company stops being a going concern, what they own actually becomes very, very relevant, and we actually can be invited to do a good old-fashioned liquidation value calculation, which essentially means if they auction off all their property, how much money would that go for? It's basically a fancy business garage sale. Well, according to this, they have a good amount of equipment, 36 million roughly in equipment. Yeah, okay. I'm guessing much of the 36 million in properties, some significant portion, is actually going to be fancy brand spanking new solar panels. And so I can leave this away with a company that was in the energy segment tried to start acquiring other companies to see if it could join the renewables market in a big way while also really taking advantage of opportunities in what probably was its bread and butter, more traditional electricity and telecommunications. These segments are similar. Like you can see how a company could be good at all three of these because of a core competency, but it just is a lot to manage lots of acquisitions, especially in different geographies, especially with different customers, and especially without really knowing if a 15-year customer relationship life is something reasonable when you're buying into a company. Acquisitions are a tricky business sometimes. What we have here now is a future clearance sale on solar panels. And so maybe somebody would be willing to buy a couple of these solar panels from them, maybe give them enough runway to operate for another year and try again. Or maybe you guys will wait for the clearance sale and get the solar panels a bit on the cheap and then pay for the maintenance on your own. I don't know. I'll let you guys decide how you want to handle your renewable energy purchases. Well, while we meditate on that story behind the numbers, I want to take the opportunity to talk about one of the YouTube channels that I've enjoyed over the years. This one's a relatively new YouTube channel, though. Benjamin. What this channel is basically someone trying crazy meme investment strategies and then actually losing money. So it's kind of entertaining to watch. Definitely more if you want to see pain, which is weirdly entertaining sometimes. Well, thank you everyone for going through another annual report with me. I didn't know what this was going to be before we got into it. It turned out to be pretty much from the get-go a pretty pessimistic time. But it's good to see that there are consequences to your actions, right? Not a bad lesson to be reminded of every now and then. I wish all the best for the people of Orbital Infrastructure Group at every level, whether they were involved in the decisions of the recent acquisitions or not. Thank you for all the feedback that I've been getting about these videos. I really do hope they are largely entertaining. That's the main goal here, is to help everyone become a little bit wiser, a little bit more comfortable with business and numbers. Please like, subscribe, share this video. Don't forget to share your wisdom. And if you guys have any ideas for a similar company to this one, or a company in the complete opposite situation, maybe doing solar panels but with profit, please share in the comments below.